All right. Good to go here. Let's see. All right. Let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with my good friend Doug Hagren. Hey, Doug.
Good morning, Kirk. Hope everybody's feeling good after Friday.
Depends what you're doing on Friday, Doug.
I was in the woods, not paying attention to anything that was happening on Friday. You know what they say? Ignorance is bliss when it comes to investing.
Lucky you, man. Lucky you. I was actively participating in the markets on Friday. Let's put it like that. Yeah, it was for those of you who were sleeping on Friday and the whole weekend. Not good for you. Good for you for not being online at all. I wish I was in your shoes, but yeah, Friday was I don't know. It depends on who you talk to. A 6 or 10 sigma event. People have come up with all sorts of random stuff, but yeah. So Friday has been we've been talking about in the show for like the last, I don't know, 6 months, 9 months, maybe more, about the precious metals complex. And so if you've been following us for a while, then hopefully you participated. Hopefully you didn't just get in last week.
We talked a lot about people that get in late versus early.
Yeah. So if you were late to the party, I'm sorry. Friday was one for the record books, and I could say I've been in the markets since 99, actually probably before that, probably like 97, 90, 97, 98. I was trading in college with myself, but like I was an advisor starting in 99. And I could tell you that only one other time have I ever seen something like this, and that was 2010 with the flash crash. And that was a ride, I have to say. That was a heck of a ride. But this was interesting. So for those of you who didn't follow on Friday, lots happened last week. So last week we had the Fed chairman announced, and we had the gold and silver markets, which were at record highs. Copper was going up, platinum was up, all the stuff, everything was up. And, and we got to a point where it was getting very volatile. And I think we had like a 12, what was it? So there were some record moves. I think it was on the 26th, okay? From 101 to 117. So you had a 16-point swing in the markets. Now, if you have charts, go back like a week and look at the daily, look at the price movements. We had one day which was a record swing in silver. It was a 16, 17-point swing, which is crazy because, if you get 1 point swing in the market, that's a normal day. 16-point swing, that's nuts. If you were following it over the holidays, there were some 6% days. There were some 7% days, both directions. That was crazy. Then you had a 16% day. That was nuts. And then to make it worse, on Friday, the silver market started at 118, and it went down to a low of 70, 71. I thought it was actually lower than that. I'm looking on the chart here. Anyway, 73. That was a heck of a day. I think it was like a 35-point swing at the most. I think it ended up like 29 or something like that. But that was a hell of a day. And so for people who just got in the markets, they're probably flipping out because all this happened in a day. And it all happened with the announcement of the Fed share. Now, is the picking of the Fed share the cause of this? Not in my opinion. What basically happened is, when the Fed share was announced, so if you think of like the precious metals market, they were on fire, to put it bluntly. And they were going up they were going up in a very unhealthy way. We talked about it in the show the last few weeks. It was very unsettling. That's not how markets work. It was way overextended. It just kept going. You didn't know why, other than the fact that everyone wanted to get in. And so right around the peak, for a few days, it kind of peaked out. And then the Fed chair announcement happened and the markets sold off. You might say, well, it was because of the Fed chair. Maybe. I don't see, this is the lesson for today. Other than don't buy at the peak. The lesson for today is you're hearing on the news that the Fed chair is the reason for the sell-off. Is it? Actually, I totally forgot to share my screen here. Let me share this just so you can see the fun that we had the other day. Okay. So this is the chart for silver. So when the Fed chair was announced, pretty much right around that time, not to the minute, but right around that time, silver and gold started to sell off. You might say, well, it's because of that. All right, let's talk through it. Did the event cause the markets to sell off? In part. Now, we don't really know the reason, but what I would suggest is that the announcement of the Fed chair was the match. It was not the bonfire. Now, most people think that that's the Fed chair is the reason. Well, the reason is because the market was way overextended. I mean, if you look at this whole period from pretty much right here, I mean, if you look at September was a big rise. But if you look at right here, it just started to take off 60 up to basically 120 in a matter of, we'll call it 2 months. And if you look at December, it got really crazy. And then it got crazy in January. It just got crazier. Now, if you look at the 200-day moving average, which is not on here, and I don't use this, so I'm not sure how to put it on. But basically, if you look at 200 average, it's probably right around where it is now. It's probably right around where it hit last night, right around 70. So it was way overextended from where it should be, way overextended. That's not healthy. That's not how markets work. Markets do what we call reversion to the mean. So it should revert back below that, but there's a lot of strength under this, so it probably won't. But the point being is that the announcement of the Fed chair caused markets to realign in many ways, and most people think he's more hawkish, meaning that he doesn't want inflation to happen and he's going to be an inflation hawk. It's unclear whether that's the case, and it's not until May anyway. So yes, he's probably an inflation hawk, but at the same time, he's also very supportive of Trump, or Trump wouldn't have picked him. So we'll see. We'll see what happens. But anyway, the point being is this happened. He was the match that caused everybody to sell off, but it didn't just happen by itself, okay? There was a large short position put on by certain banks. I'm not sure if that was the reason. Could be. But when you start to see this, it means people started to short it. Now, here's also what happened. What also happened is volatility picked up. Let's see if I can pull this up. So volatility went through the roof starting around mid-January. Volatility went through the roof on silver. And if you look where it was similarly an all-time high, or at least, I don't know, it was all-time high, but at least for the foreseeable past, it was a high. And when that starts to happen, people start to short it, and they short it through options and other things like that. Because this is going to be a very basic lesson in hedging, but with banks and big institutions, if you have high volatility, so let's say, I think it was, let's say 2020. 2020, I think the VIX hit all-time high. It was like 80 or something like that. If it's at 80, you can make a heck of a lot of money by selling volatility, okay? And I'm not going to get into an advanced lesson in selling volatility, but just understand this, is that when things get crazy, and this chart of silver is crazy, like it was unhealthy, it was making money, even though I own silver and a lot of people own silver, it was making me very uncomfortable, the fact it was going up so much, because it was not normal, right? So that means volatility is really high. You can make a lot of money selling volatility. The reason that Bitcoin is popular is because people can sell volatility. outside of the speculative nature of it. So what happens is big institutions and banks sell that volatility. Well, that puts pressure on the price because it's basically you're shorting it. I'm trying to simplify this, but you're basically trying to short the price of the security. So all that pressure eventually puts it down. And I suspect that I had heard that there was a big short position from JP Morgan. I believe, if I understand the news, that they used to be short silver. And then I think this summer, they put on a 750 million ounce long position. And I believe now they're like, I don't know, 100 million ounces short. So it could have been just that a bank took advantage of this and shorted it, and then they'll take that short off and then it'll go up again. This is why you can't look at an explanation in the media and say this is the truth, because there's so much to this that you'll never see and you'll never know because people aren't going to disclose their positions because they don't have to. So if somebody shorted this in a very big way, puts pressure on it, it drops, and then they remove the short position, they just made a lot of money. But now there's relief up there, and now it can rise again. So I suspect probably today and tomorrow, silver is going to it's going to bottom out because people have been cleaned out and new people are going to come in and start buying. I can't say what I'm going to do because I don't get in trouble. But let's say I'm optimistic about this price action. But the point being is that if you're looking at all this, I would say go back and look at the price action, look at the news. It was awesome. Like I've seen like quick replays of what's happened. It was crazy, and I'm glad I got to live it. And just like I got to live the flash crash, I was actively trading that day as I was Friday with silver and gold. I was glad I got to live it. It was something for the record books. It's one thing that you just say, "Wow, I got to see that." It was not fun, right? People don't like losing money, but I can say that it's. I would be highly surprised if this is the end of the precious metals run. Highly surprised. I think there's going to be a lot of acquisition around this level, and I think it may not go straight shot back up. I think that's probably unlikely, but will it rebuild, and will we have some positive momentum at least over the next week or two? I think so, but we'll have to see. Now, if you look at gold. And I'll give it to Doug because I want him to have a chance to chat about this. Gold's actually, we had a spike here in gold that was unhealthy along with silver, but it's kind of come back down to a spike. So it's actually at a healthy level. So if you look at this and you draw a line, it's actually right where it should be. Silver actually do the same thing, even though it's a lot less healthy. It kind of broke through that. But actually, if you draw a line here down to 60, we got another $10. I would say, okay, that's still actually a healthy place where silver's in a bull market. So if you look at things like platinum, platinum much the same. Platinum's a little different, but I would say it's kind of come to a similar place. Copper, I will say copper's a little bit weird. So copper kind of spiked up, and then it's got this range in here that it's bouncing around in. I mean, copper's still bullish. We still need more copper, right? Silver is still a strategic metal. You look at palladium, also weird kind of cropping here. But here's how I would look at gold. Gold is a good healthy indicator because gold is getting buying pressure from central banks and insurance companies and banks around the world. And I think a lot of people look at this as a good opportunity to buy. You're probably seeing the same thing happen in crypto as well, is that banks and other institutions want to buy it, and a bottoming out of crypto is actually a good opportunity for them to acquire. So if you look at this price action, I would be very optimistic with this and say, look, it hit this support level. It's going to get some attention. It might go a little lower. I wouldn't be surprised if it went a little lower, but I do think it'll probably center around this area, the 4,500, and I think that would be healthy. So Doug, what are your thoughts? I know you were hunting, you missed the whole thing, but I know you have thoughts. So this weekend was interesting in reading up on what was going on. But what are some of your thoughts on the metals?
Yeah, well, I'll start with the last part. First of all, I wasn't hunting. I was in the woods. I was on a school trip with all the seventh graders up in northern Minnesota. Got to experience lots of incredible outdoor time with them, ice fishing, survival skills. They were working on snowshoeing, got to kind of experience kind of an old pioneer kind of setup village and native. It was fun. It was a great time. So first of all, I want to start with one thing on the gold silver ratio, and then work our gold and silver and work my way backwards. First, so by the time we got to Thursday, going into Friday, silver. I'll start with that. Was bouncing between 3.5 to 4 standard deviations outside the 200-day moving average. Historically, when we get to 3 standard deviations outside of a 200-day moving average on anything, there is about a 90% chance of correction. Some analysts have said it's 100% of the time. It's basically, an expected given. And once you get to 4 standard deviations, it's a whole different beast. So, I mean, we were getting to the point where, even if you want to say, if people want to say it's the new Fed chair, again, probably a match more than the cause. But the reality is, from a technical standpoint, it had achieved a point in which there is almost a 100% 100% reversal that happens. And you got to remember, we've talked about this before. We are in a world now where computers run a lot of things. Not only do the computers run a lot of things, but as Kirk said, you were saying, we still got people out there that are making fundamental decisions around technicals. And once you start to get those stretches and they see that opportunity, you're going to see a lot more taking advantage of trying to capitalize on taking profits, shorting, things like that. Secondarily, and this is one we've talked about too, is the current gold silver ratio now. I mean, now that gold has pulled back to around 4,900 an ounce. Silver had been around 98 an ounce. Now it dropped a little bit more than that. It's now down to 70. So this has changed a little bit. But when it was at 49 and 98, the gold silver ratio had now gone back to 50. And we had talked about how stretched the gold silver ratio was. I even said last week or the week before, if gold stays where it's at, silver's got to come up historically to get in line with gold silver. The long-term centuries gold silver ratio is about 55 to 60. Modern fiat area normal is a little bit higher than that at 60 to 80. Post-crisis spikes, risk off, it can get into that 80-120 range. When we're in strong inflationary environments, it's more 40 to 55, and extreme silver outperformance 30 to 45. So 50 puts us right back in long-run historical averages. So one of two things had to happen, at least in terms of that aspect, is silver had to keep running to catch up with gold, or we would get a very strong snapback. And if both of them come down, gold comes down, then you get in line. Now, granted, silver now has fallen down into the 70s, so I haven't run the newest calculation since then, but we're probably getting to the point where, again, with the drop of silver compared to the drop of gold, we're probably a little bit below that, that gold silver ratio again, which means that, like you said, there might be opportunity now for silver to come back. But we're getting back into historical, that historical long-term average. So we've got, that means silver, relatively, especially now in the 70s, is stronger relative to gold than normal. That's historically a bullish structural sign in commodity cycles. It isn't necessarily a return to extreme. If it isn't at extreme values seen in historical monetary crisis events, we're not just in a risk-off panic repricing. So I don't want to get too deep on that, but again, we've talked about this gold-silver ratio. This snapback puts you more in line with that. And when we get into the 3.5 to 4.5 standard deviations that we were at, and this is a really good rule of thumb for anybody that's watching anything you're holding. If you take a look at standard deviations, when they start to get stretched, whether it's human decision or computer decision, especially when you get to a 4 standard deviation, you get a very dangerous scenario where positioning is crowded, risk managers step in, systematic strategies de-risk, options hedging is going to accelerate moves, and small catalysts are all that's needed to trigger large reactions. This isn't psychology, it's mechanics. It is just what it is. So you don't add risk at 4 standard deviations, you manage it. And really when you start to get outside 3 standard deviations, most of the time it is a really good, strong signal to look at trimming, rebalancing, hedging, reducing leverage, and separating long-term thesis from short-term exposure. Okay, so this is it isn't bullish, it isn't bearish, it's unstable at that point. So, so from that standpoint, nobody, again, what happened with the new Fed chair is it's probably the match because that standard deviation was already in those extremes. It took something to cause that little bit of a snapback. So just again, a good rule of thumb to think about. I do want to talk a little bit about the new Fed chair. If I could jump into that a little bit. There's a lot going around about his background and who he is. He was a former Fed governor from 2006 to 2011. He's a Wall Street veteran, and he's also an academic, and he's now aligned with the current administration's growth-focused agenda. That's why he got picked. It's drawing a lot of attention because, as you mentioned, he has a history of being someone who's known as an inflation hawk. But he's also got a track record of stated positions that signal a shift in how the Fed could operate going forward, especially in context of persistent inflation, fiscal pressures, and political expectations. But even though he's known as an inflation hawk, wary of loose money, rapid expansion, more recent commentary from him, which is probably what got him the interest of the presidency, he has actually signaled an openness to lower interest rates, which is what the administration is pushing for to stimulate growth. So it makes it a very unusual mix. He's traditionally hawkish on inflation. He's been recently accommodated of rate cuts. He's supportive of growth and productivity narratives, such as AI's role in reducing inflation. But what this dual stance approach could look like is you could see possibly lower short-term interest rates to support growth, but maybe longer term, a reduced emphasis on forward guidance and forecasting. That creates a lot of volatility and uncertainty. When you throw things out, you're starting to see a lot of companies pull back on that. And there's possible depreciation of the Fed's balance sheet via quantitative tightening while he's still cutting rates. So this kind of fits into lower rates, but that kind of more Doge mentality of trying to cut where costs are. So what does it mean for you? What does it mean for the markets? Rate cuts, obviously, have historically been thought of as something that can boost growth-oriented stocks, especially cyclicals. There might be a more predictable, growth-friendly Fed that could reduce short-term volatility. And there could be, a continued call for a leaner balance sheet and alignment. A Treasury Fed accord, per se, could increase confidence among bond investors. And if we can get the bond investors stabilized, it's going to have a huge effect on everything else. We said this, we kind of threw that out there a week or so ago. Got to watch Japan. The Japan bond scenario is extremely telling, and it is extremely dangerous about how leveraged, the Japanese bond market is. Where are the negatives? If rate cuts are too aggressive, this is something that's been questioned. While inflation remains sticky, real yields could rise. That can hurt stocks and fixed income alike. Get a real double bang. By the way, so again, it was a rate increase that kind of caused that 2023 dual crash. Opposite of this, you get too many rate cuts, you can still get the same thing. So rate manipulation can still have a huge effect there, and can sometimes really eliminate a lot of safe places to put money. Government fiscal spending and deficits, they can actually overwhelm any rate cut benefits for markets. That means monetary policy by itself isn't going to fix underlying structural problems. So the market's reaction so far, again, if it's correlated, not sure if it's causative, match, stock indexes dip modestly. If you look last week, commodities got hammered, but again, those standard deviations. The rest of the market didn't move. I mean, the S&P 500 was down modestly, so the overall markets didn't really react too heavily to on Friday. A lot of what the news was in the news had more to do with crypto and I'm sorry, precious metals, commodities, things that had been really moving to kind of end last year and start this year. But the other thing too is that it was interesting. There was these rumors of, well, the dollar's weak. Actually, the dollar strengthened last week. So again, there's a correlation there, not necessarily fully causative with a strengthening dollar, effect on the pricing of precious metals, and then investors getting a little bit more wary about policy direction. So we've said this before: if there's confusion or concern about the outlook, it's always going to be it's always going to not all. I hate to say actual extremes, not always, but many cases it's going to cause more volatility in the markets because the markets don't like uncertainty. So yes, announcing a new Fed chair, looking at the background and seeing very quickly, oh my gosh, inflation hawk, this. Whoa, that's going to create some volatility. But as they get more clarity, as he starts to kind of you start to see where he might be able to go, then you're going to start to see things stabilize a little bit more in that area, especially as they snap back into normal standard deviations. I just want to kind of finish with this. What are some of the critics worried about? The Fed could lose operational independence. That has been something that has been touted out there for a while. As there's been more public pressure from the administration for rate cuts and joking about, suing the nominee if cuts don't happen. But again, it might be a joke, but it does signal a political backdrop. Monetary policy could track political objectives at the expense of long-term stability, and markets may begin to price in political risk as part of monetary policy decisions. Real challenges for the Fed chair coming in. It's not gonna be easy. I mean, inflation hasn't returned cleanly to target even after rate hikes. Sticky prices remain in rent, services, healthcare, tuition. Markets may challenge a dovish pivot if the inflation persists. Fiscal deficits are massive, huge, and monetary policy can't address this government spending directly. It's going to make Powell's legacy of balancing inflation control and growth even more relevant, and he's going to have to balance trimming the balance sheet with this accommodative rate stance, which can pull markets in opposite directions. So, big picture summary, just going to leave it at this, and I'll turn it back to you. Policy may shift towards growth over strict inflation targeting, and that could mean more, could support equities in the near term, but inflation risk isn't going to disappear overnight. Rate cuts, they might happen sooner than markets initially priced, but they may be smaller and more conditional than expected. Central bank independence is a live issue. I mean, the Fed's credibility may be tested if political pressures grow, and then there's still structural issues that remain: debt, sticky prices, income risk. Those aren't just going to be fixed by rate decisions alone. Monetary tools are going to have limits. The last thing I want to say, and I'm going to get deep into this right now, I'm going to let you address it, but there's been this word, it's like, oh, he's a modern Volcker. Welcome back to the 1970s. Conceptually, I think people want him to be. Practically, I don't think the system's going to allow it. Volcker could do what he did because economic, political, debt backdrop was completely different than where we're at right now.
Yeah. All that being said, appreciate the digest, Doug. All that being said, you can completely ignore the fact that we have a new Fed chair. A, it doesn't happen till May, and B, it doesn't matter, right? There's. I want to get into something else, but I just want to just say this 2 cents is. Every time a Fed chair gets anointed, they take him in the back room and they do a lobotomy on him. If you look at Greenspan before and Greenspan after, completely different people. He was pro gold and all this, and as soon as he was Fed chair, he did the exact opposite. I think they take him in the back and they just brainwash him into doing whatever they want because he has his thesis and he's a smart guy, but once you're in charge of the Fed, it's a very different scope of understanding. All right, so let's move on. Hold on.
I just want to say this real quick. I think that's funny for everything because you hear politicians always campaign, we're going to do this when we get into office. And then when they get in office, things change. Why is that? Because they get in, they go, okay, let me tell you what's really happening.
Yeah. It's it's very normal. That's what, yeah, exactly right, Doug. That's why every politician doesn't do what they're saying, because they get in, they're like, oh crap, because they're more interested in the power than anything else. But all right. So we're going to go into a few things here. I want to get to a bunch of charts today. So the first one's a chart crime. I'm only mentioning this because it's a chart crime. I saw this and I laughed. So if you look at this, it's equity ETF flows continue to break records. Yeah, because people didn't start putting money into ETFs until right around 2006. So if you're doing the starting point, yes, there certainly is more. It doesn't matter. It's going to continue, and it's going to be away from mutual funds and more towards ETFs. So this is a chart crime just because it's it's trying to say, oh yeah, more money is going to ETFs. Yeah, no kidding. Yeah, there's more money out there. Look at 2020. All of a sudden, they printed a lot of money, and look at it all went to ETFs. Can you imagine that? Where do you think it would have went? So I look at this and I just kind of laugh because a lot of people, they point to this and say, oh, well, this is the reason for X. No, it's not. The reason is because people aren't using mutual funds. ETFs are getting more liquidity, and there's more liquidity in the system, which is pushing it up. That's the reason more than anything else. It's not for any other reason. People have money, they have to put it somewhere, and it's not mutual funds. Now, I guarantee you, if ETFs didn't exist, the mutual fund chart would look like this. So you can't always take things at face value. Now, I want to talk a little bit about the midterms. So we went into this before, but I want to share this. I got a few charts. So if you look at a 4-year cycle, I was talking about this, but this is a chart I'm actually sharing. So if you look at a 4-year cycle, what you'll typically see is the first year is pretty good. The third year is great. The fourth year is decent, and the second year is the worst of the four. Does this mean that the markets are going to crash? No. What it means is, in comparison to the four, it tends to be the worst of the four. Now, if you look here, it's still positive, although I suspect that's maybe a little off. But obviously, the first year hasn't aligned. It's been off. It's not aligned with the average. And by the way, the black line is the average. I could see us having a pullback this year for sure. I wouldn't be surprised if that was the case. But this year is going to be a big year. It's going to depend on what Trump's able to do, and is he able to maintain power throughout the midterms? If he is, then the next 2 years are going to be interesting. If he can't, then I think the next 2 years are going to be a wash for him, and he won't get much done. So we're going to have to see what happens. But I just wanted to share that and share the fact that it doesn't mean just put all your money under the mattress. It means just be careful. Your all bullish all the time attitude may not work this year because it tends to be lacking in performance overall. This is the seasonality for months. So if you look here, although this is a little off, January is usually a good month. I don't know why this is showing. But anyway, so this is showing, this is midterms. Okay, so this is only during midterms. So during midterms, it tends to be down January and February. Obviously, January was a decent month. The markets are up like 1.5%, I think it was. February is typically down, and then it starts to take off. So I look at February as one of those months where, if I could help it, I'd be on the sidelines. It doesn't mean it's going to lose money, but it means that right now, some markets, especially precious metals, are way overpriced, and actually not so right now, but they were up till Friday. If you look here, bear markets are bad years. I don't think we're in a bear market. I think we have a lot of positive sentiment. We have a lot of positive money flows. We have a lot of positive GDP growth. Sure, we have inflation, but we have a Cape-shaped economy. The people in the bottom part of the K are struggling. People in the top are making lots of money. And I don't think that's going to change. Trump said the other day, his goal is not to reduce real estate prices. So if you own real estate, you're going to make money, and it's probably going to keep going higher, which means lower rates. And do I think that he's only trying to help the rich? No, I think he's also trying to lower rent and other things. We'll see what happens. It's still a little early, but his intention is to bring down inflation for the everyday folk, because that's who's going to vote for him. If you can't afford to put food on your table, you're not voting for Trump, because he promised he was going to help in a lot of different ways. So everything he's trying to do, if he wants to win the midterms, that's what he's got to do. And I'm assuming he very much wants to manage the economy so he gets so the Republicans stay in power. That's my thesis. He wants that. He wants it very much. This is his goal. Virtually no presidents are able to do this, but that's his goal. So if he's able to do it, what does he have to do? Well, he has to help the people in the bottom of the K. That's what he has to do. And that's lowering rent. That's lowering cost at the store. It's lowering oil prices. All that stuff is what he needs to do. So here's, I'll miss this. And okay. So I want to share a bunch of charts because we ended the first month of the year, and I really want to run through these because I think it's important. We had a crazy January. January was pretty good. If you look at indexes, small cap, micro cap did the best, up 5.5%, which is pretty darn good for January. If you look at the S&P, it's only up 1.5%. Okay, it's good, but obviously not as good as small caps. Small caps broke out. They broke back down the other day, but they're still doing well. This is as of Friday, I believe. Or no, I'm sorry. No, this is as of the end of the month, so it missed Friday. If you look at the sectors, what did the best? Energy did great. Energy's up 14% in January. Hopefully you're in energy. that was kind of crazy. Materials.
I'm spending on it, Kirk. Does that count?
What?
I'm spending on it, Kirk. Does that count? I just got my my heating bill.
Well, you're the reason why energy did so well, Doug, because you're spending a lot of money.
It was only minus 22 in Minnesota.
Only. That's a normal day, Doug. Is that why you took the kids out to the woods because it was safe from the woods in the cities? Yeah, get them away from the cities, Doug.
But it did help your ice rink.
Yes, it did. It did. It was good time skating. Materials did well, up 8.5%, 7.5% for consumer staples. I just want to point this out. So if you look at the areas that didn't do well, technology, financials, healthcare. If you look at the areas that did well, energy, materials, staples, industrials. So this is interesting. I want you to keep an eye on these areas. Energy is an area that I would be very, very much watching this year. I think there's going to be a lot of energy has been out of favor. It is a part of the commodity complex. So commodities are getting a lot of interest because of inflation, and energy is part of the commodity complex. I will say that because energy prices are lower, it's good for the average consumer. But I don't think it's going to be like that forever. I do think we're going to have I do think we're going to see a pop in energy at some point this year in prices of oil. And certainly cold winter is going to help. But I would keep an eye on energy. For those of you, audio viewers, I would go and look at the YouTube video. We'll go over all these returns. But these are the areas you should be looking at this year. January is an indication of what the rest of the year could hold. Now, do I think that energy is going to be up 5,000% because it's up 14% in month one? No, I don't. But I do think it's a marker for where you should be paying attention. This is where the money's going. This is where the returns are going. Materials, those are commodities. Staples, here's another area. We haven't talked about staples yet, but we're going to start talking about it. I would go and look at some of the staples. Look at Walmart, look at Coca-Cola, look at companies like that. They were bottomed out in in December, right? They were beaten up. You look at some of the restaurants, they're all beaten up. I think we have Chipotle this week, which is one of the better companies in that restaurant area. So I'd keep an eye on that. I'd keep an eye on some of these companies because I think that Staples is actually a good area to keep an eye on for this year. Industrials have done consistently well. Look at this in the last 18 months, up 30%. They've done very well. They're consistent. People don't talk about industrials, but I would keep an eye on them. They're also kind of on my clock here. The rest of them, I think, I wouldn't. I'm not paying too much attention to at the moment. If you look at the industries, here are some of the best performers year to date. Oil service, it's energy. That oil service, you have oil and gas exploration. So if you think about the sector and think of where the best returns going to come from, it's oil service and oil exploration. And I think some of the oil service comes from Venezuela. So that's not exactly entirely a full a full read because of that one event, but it's still, as you can tell, these both are on there. Semiconductors are still doing well. I'm going to share a chart in a little bit, but there's a big divergence between semis and software. What runs the software? Semis, and vice versa. You can't have one without the other, and software is in the toilet and semis are at all-time highs. I do think there's going to have to be a reckoning where they converge back again, and I'll show the chart in a minute. If you look here, what else? Energy, solar, nuclear energies up there. We've talked about that. Aerospace and defense, another area that's hot. So you want to look through these and you want to see what is doing well, what is not doing well, what's not doing well. Software, healthcare providers, medical devices, insurance, internet, cannabis. So just keep an eye on some of these areas that are doing well and not, because it could be an indicator what the rest of the year holds. Here's a Mag 7, okay? We've been talking about this the last few weeks. Mag 7 is not participating. Microsoft got killed last week in their earnings. Their earnings are actually pretty good, but people didn't like the CapEx spend on AI. Apple didn't do well. Tesla, things that did do well, Meta and Alphabet. Alphabet's actually and Amazon have earnings this week. So keep an eye on that. That could determine the path of tech. Then you've got factors. We won't spend a lot of time on that, but just understand that dividends, value stocks are trending better than growth. If you're looking at these other alternatives, I won't spend too much time on that. Fixed income, what's doing well? Well, government bonds. The fixed income space is going to get a lot of attention this year because if interest rates start dropping, you want to know where the money's going. Where's it going? Is it going into mortgages? Is it going into treasuries? The banking sector is going to be in upheaval, I think, and it's an area I would be very cautious about. I'm not saying it's do poorly. I would just there's so much going on. I don't know where it's going to go, and when I don't know, I just tend to stay on the sidelines. And then major commodities, even this year. So this is the end of the month. Energy did a lot better than precious metals, if you can believe that. I don't know how that's possible, but they did. So that's just something to keep in mind. You want to be mindful of where all these things are going. Here are the commodities. Best performer, natural gas, uranium. Well, that's why. Right, there we go. Natural gas is up 37, almost 38% for the year in the month. Uranium's up 28.5%. The third place is silver at 17. Crude oil is at 15. Gold is at 12. So that's why energy is doing better, because we're colder winter this year, as well as the fact that a lot of these prices are bottomed out and they're starting to rise. Uranium has done very well. You all know my opinion on uranium because we talked a lot about that. But these are things. And here's global markets. What's doing the best? South Korea. I honestly don't know why, and I'm not in South Korea, but just something to keep aware of. Latin America, Brazil has done well. Mexico, Saudi Arabia, Hong Kong. So you want to know internationally. Here's the U.S. Here's everything else. World ex-U.S. is up 5.5%. The United States, the S&P is 1.5%. If you don't have international exposure, you are shooting yourself in the foot. Okay, you should have international exposure. It did really well. It almost doubled the performance of the S&P last year, and it's continued to do well. You think America first. The result is it's not America first. America is last in terms of international performance. So keep an eye on international markets. Figure out a way to put money internationally if you don't have some. I'm not saying all of it, but if you don't have some, you should, because if you want to diversify and have money in different places, that's one of the ways to do it, especially when it's doing well. And the last one is just currencies. The Australian dollar, Swiss franc are doing well. The dollar's down. The dollar actually had a pop with the Fed chair announcement where it broke below support and then it popped back up. So we'll see where it goes. It's still early. I'm not counting my chickens yet for where I think the direction is, but I will say that it's something to keep an eye on. And then I'm trying to find my last. Oh, here's one last thing on silver, and then I'll turn it back to Doug two more quick things. So first is I saw this. I never look at these because they always tend to range in a certain area. This is the silver ETF premium to discount. It was at 19.17, I believe, discount, which means that the price of silver was 19% higher than the price of the ETF. Now, this is what happens when markets get really screwy and you have these big flushes out of the system, is the price doesn't necessarily align with the futures. I didn't realize this till then, but this is a good reason why the silver ETF should start to bounce, because it should be 20%, 19% higher than the actual silver price. So on Friday, I will also mention on Friday, there were a lot of disconnects between the price of silver in China and Hong Kong than it is in the US. I believe that will probably be cleared up today, because if you have, so let's just say, for example, the price in China of silver was $110 and here it's 70. Well, all I have to do is buy silver here and sell silver there, and I make that spread, and they eventually come to the same place, and then I make the difference. So that's what institutions do. That's why you don't see these big discrepancies between international and here, is because, well, you just sell there and you buy here, and you own the same stuff. Like you're still neutral, but you own that spread. So whatever that spread is, you wait till it comes back to even, and then you close out the positions, and then you make the price. It doesn't happen often, and most of us can't do that or won't do that. So I'm just pointing it out as something institutions do, and that's why prices don't tend to skew. So that's kind of an anomaly. Last thing I'll say, and I'll give it back to Doug. This is the earnings calendar for the week. Okay. This morning we had Disney, which showed that everyone's still spending money. You have Palantir after close, which is, a big interesting thing, since they're a part of the AI revolution. We have Chipotle tomorrow after close, AMD after close. Looking at semiconductors, we got Amgen, we got Eli Lilly, we got Google after close on Wednesday. That's going to be a big one. And then you have on Thursday after close, you have Amazon, and you also have Strategy, which will be interesting since they bottomed out. But you also have, I believe, ConocoPhillips, Shell. So there's a lot of earnings this week to keep your eye on. I would just be aware of what's going on more than anything else. I think Wednesday and Thursday will be big days with Google and Amazon, so it's just something to keep an eye on. And if you're trading around tech, I probably wouldn't. Everyone likes Google right now, so I'm sure they'll do well. But Amazon has been struggling to break out, so we'll see what happens. But Doug, final thoughts from you?
Yeah, I just want to go a couple things before I close it out here. I think there's a couple key points just to look forward to, look at. Something that hit the news, some people have been pushing on the world of FinTwit and social media, is that there was a bank failure last week. The reality of that, so you might be seeing that. I've seen it popping up all over the place, like, look at it, there's more to come. There was a small bank failure in Illinois. It was a $19 million hit to the FDIC, which is what we like to call a nothing burger. But even though only one bank has failed recently, there's still broader vulnerability that remains in small regional lenders, especially those that could be exposed to commercial real estate, low deposit diversity, and rising uninsured deposit ratios. One failure doesn't mean systemic, of course, especially as small as it is, but it does highlight a credit risk. And the FDIC resolution mechanisms are working. Bank stress, just be aware, it hasn't gone away. It's just moved from the headlines to the balance sheets. It's still out there, and a lot of banks are still significantly, sitting on significant unrealized capital losses. We haven't talked about that in a while. The yield curve behavior, future growth expectations. Recently, the yield curve has shown a persistent inversion pockets. It's not random. It's expectations of slower growth baked in. So, yield curve isn't predicting a crash. It's pricing in slower growth with risk, kind of in line with what you said earlier. You did say, this year could potentially be weak, or could even be a down year. We did show that historically, when we've had, a couple years of double-digit growth in the markets, that has been bullish for a third continual year. So, again, obviously, historic, something to look at, but hard to, it doesn't give us any type of insight as to actually what's going to happen. The dollar's been volatile. It's caught between safe haven inflows and weakening fundamentals. You're seeing dollar strength against emerging markets debt stress. Just understand that the dollar, when you're watching the dollar, it is it is not just about money. It's not just about fiat. It's important to look at how currency impacts inflation, commodities, and multinational earnings. Dollar weakening is part of precious metal strength, not just inflation. But more so, the reason to watch the dollar is it's not just money; it's It's a confidence index. And I think that's, so just kind of watch where those trends go. Will tell you a lot about where confidence is going to go. The U.S. is on pace for one of the largest Treasury issuance years in history due to the deficits, funding maturing debt, higher fiscal commitments. Debt issuance isn't just a line item; it's a yield driver. So expect that could have more impact on mortgage and spread markets, the role of foreign buyers, domestic holders. By the way, just so you know, with like all this talk about the United States and where we are with relations to everybody else in the world, international investors have been one of the biggest buyers of U.S. stocks as of recently. So that tells you, again, a lot about confidence of where our economy is and where our companies are in relation to the world. There's still a lot of strength and support there. Aggregate savings, understand this, they've been quietly contracting, especially among middle income cohorts, even as headline unemployment stayed low. What that means is, what that can mean is, impact on consumer spending, debt service stress, market slowdowns. So you don't see stress when savings linger. You're going to see it when they stop. So this could, retirees and near retirees have very different liquidity profiles than younger cohorts. That's going to be very important for you that are putting together financial planning. Really understand the importance of having liquidity in retirement. Another thing we saw small. By the way, I saw in your charts, micro caps have reversed recently. They were one of the biggest, biggest growth areas last year. We talked about the risk of not micro. I'm sorry. Yes, micro caps. They have pulled back. They can be very volatile. So even while major indexes flirt with highs, small caps and breadth indicators have lagged. So a market of 7 stocks isn't a healthy market. It's a fragile one. We still got housing inventory issues. Housing's rising. Migration patterns to the Sun Belt, secondary cities are reshaping local markets. That has affordability implications. Real estate isn't one market. It's like all of these local economies. So again, things we've touched on, we'll continue to touch on. When you hear about what's going on with real estate, you got to really dig into where that's going to be and where inventory and demand is regionally. I want to talk about student loans, and corporate earnings to finish this out. Without specific charts, this week, new policies are tightening student borrowing capacity. We are now into the throes of the one big beautiful bill. That's going to shape borrowing capacity and future graduate debt. That's going to have effects on labor force participation, potential home buying timing for new graduates. They're trying to go after and start to force payments out of income paychecks for debt that's been that's getting behind. So watch education policy because that's family finance policy. And then lastly, profits for corporate earnings and economic reality. The earnings have been resilient in aggregate, but underlying picture is uneven. Big tech still carries many of the indexes, but as we've seen, that's starting to pull back in terms of the markets. Traditional sectors are lagging. You mentioned consumer staples. One thing I'd be very careful with, I think you're right on watching consumer staples, but if you go back and look at consumer staples through the years, it tends to be positive in short cycles. It is not a buy and hold area typically. So just use that as a way to build some stability or maybe some short-term opportunity in your portfolio, but be very careful. The long-term holding of it does tend to lag other areas long-term. So keep in mind right now, profits can be strong on paper, but still weak under the hood. So when you pull all of these threads together, precious metals stretch but repricing, inflation that's quieter in the data but louder in real life, a new Fed chair that's navigating politics and debt, and markets rotating away from old passive assumptions and elections coming up. We got the midterms coming up soon that are going to add another layer of uncertainty. The message is going to be consistent. We're not in a moment. We're in a regime. And this is the kind of environment where affluent families are actually more exposed, not less. Complexity, that's going to magnify your mistakes, and wealth without structure can quietly drift into risk it was never meant to take. So this is why clarity is going to matter now more than conviction. And you need to start looking at things differently than where they were. You need to see how things fit together. Investments, income, college funding, taxes, legacy. These are not separate areas. They are dominoes that all touch. One falls, they can all fall. So each dollar has a job. Retirement income needs guardrails, not just protections. College funding needs structure, not just hope. And your asset allocation needs to rotate with regimes, not just stay locked in these yesterday assumptions. And so this isn't about chasing gold. It's not about timing markets. It's not about predicting the Fed. It is about building a plan that's going to hold up whether inflation runs hotter, rates change direction, or policy shifts again. So if you're an affluent family and today's conversation felt a little bit uncomfortable, but familiar, that's not coincidence. It's a signal. Visit us at mergentadvisors.net, MERGENT, mergentadvisors.net, MERGENT, to learn how to map it out, to learn how to stress test it, and to make sure that your plan is built for the world we're actually in, not the one we wish we had. Markets rotate, policies shift, costs rise, but plans with clarity and guardrails will always endure.
Great. Well, thanks, Doug. Appreciate you coming to the show. I'm going to share the chart I was looking for earlier. And oops, wrong one. There we go. So here's a chart I was looking for earlier: semiconductors versus software. If you can see this, they generally align, and as you can see, they started to misalign somewhat recently. Software's started to decline since the fall, and semis kept going. There's going to be a convergence at some point. That could be software comes up, could be semis come down, could be both, but that won't last forever. So I wanted to share that. That's kind of one of those things you look at and you're like, isn't that interesting? So I wanted to share that. And then I think there was one more I wanted to share as well. Here we go. And this last one was the dollar versus international. So this is international in blue and the dollar's in black. So when the dollar's going up, international is going down. But now people are talking about the dollar reversing, which should cause part of the reason why international is going up. But I think that'll continue. So, we look for correlations like that. There is some support in that, and when you start to see money flows in certain areas, you just want to be aboard. So. Stay frosty this week. It's going to be an interesting day, and probably even tomorrow in the precious metals markets. But don't get scared out of it. The trend is still, surprisingly, even after Friday, the trend is still up. It got so overextended that it caused that to get way out of whack. But the trend is still higher. We're still above trend, even though it hurts. Things like this tend to happen and people get scared out, and then people come in and buy, and then it starts to go up again. I would be careful here. I mean, if you haven't got in, it's actually a good opportunity to get in. If you are in, I would just be patient and have an exit plan in mind. I have one, and there's a certain, I don't think that the bull market's over in either one of them for various reasons. We can get into next week, but I do think that it's going to scare a lot of people out, which is a good thing. We need that. We need to get the they call animal spirits out of the markets a little bit, so that it can slowly climb like it did last year up until the fall. The fall things started to get crazy, but prior to that, it was just creeping up every year, and you could count on it, and it was great. But it's just gotten a little out of control. So we're going to wrap it up in the interest of time. That's the show this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisory Group. We don't just manage your wealth; we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app for your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not, excuse me. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email to express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.